All right, perfect. You can see my screen, Shri?
Yes, sir.
Okay, perfect. So starting off with chapter 4 here, let's get a strong understanding about what's in this particular reading here. As you can see, the name of this reading is the financing decision. And we'll look into this particular chapter and get a strong understanding about everything that there is. So starting up with the introduction of this chapter, what is really telling us about. So chapter 4 basically links the investment decision to the financing decision. What chapter 4 really does is that it links the investing decision to the financing decision. Investing decision is whether should we invest or not. Financing decision is basically how do we finance that particular project. So chapter 4 links the investment decision to the financing decision. It looks at the financial system, then the choice between debt and equity. Should we go for debt? Should we go for equity? And finally, the practical features of each, which is better, of each individual source of finance, like which is better. So that is all about us understanding about the high level what this chapter is going to be about. It's going to talk about what is better for us. Is debt better for us or is equity better for us? And in the long run, what is something that's really going to help us make our projects worthwhile? So looking into that here, that introduction was all about it looks at the financial system, looks into debt plus equity, plus looks into features of finance. So three things it looks into. Okay, the first part looks into three things. Number one is at the financial system, second is at debt versus equity, and third is features of finance. Right? For example, company has approved a new factory, that is an investment decision. Now decide bank loan or issue of shares. How do we get the money to buy that new factory or to build that new factory? That comes under the part of financing. So introduction decides we'll put a factory, financing decide what do we do. Do you take a debt? Do you take equity? And how do you go about it? Next, we'll look into the financial system and the details of financial system here. Let's get a strong understanding about that. Looking into this aspect here about financial system and the other aspects around it. So firstly, when we talk about the financial system, it takes money from people or companies with extra cash who are the savers and gives it to those who need money. They are the borrowers, right? It also provides a payment system plus insurance plus manages risk. So that is pretty much high level about what the financial system is all about. It takes the money from the people or companies who have extra cash, they are the savers, and gives it to those who need the cash, who are the borrowers. It takes the money from the savers, gives it to the borrowers. It takes money from the savers and gives it to the borrowers. Okay. So the financial system is the network that channels the surplus fund savers to those who need the fund. They are the borrowers. Okay. It also provides payment mechanism. It creates liquidity, offers financial services, and helps to manage investment risk. And also it helps to manage the investment risk. This is about the financial system that it takes the money from the people and the companies with extra cash and gives it to those who need money. Also, it provides payment systems plus insurance plus managed risk. That is mainly what we will study about in the financial system. That it takes the money from the savers, gives it to the borrowers, and also includes payment mechanisms, creates liquidity, other insurance services like other financial services like insurance and pension, and finally, it helps to manage risk. A little bit more on the details, right? What do we look into when we talk about the financial system? So, a little details about the financial system and the financial markets. So, when I talk about the financial system, it has certain components. First component is financial markets. Second is financial institutions. So financial markets are like the stock exchange, money market, forex market. These are the financial markets. Financial institutions are bank, insurance companies, and pension funds. Okay, so companies, example, companies issue bonds on the stock exchange. Insurance companies buy those bonds. So long story short, when we talk about the financial system, there are two parts to it. One is the financial market, the other is the financial institution. Okay, so financial market is made up of stock exchange, money market, forex market. Financial institution, on the other hand, is made up of bank, insurance companies, and pension funds. So that is what the financial markets and the financial institutions are made up of, and these form the financial system. The financial system, as you think, is high level first financial markets, then we have our financial institutions, and then we have our financial assets and liabilities. Financial assets and liabilities would include shares, bond, mortgage, and bills. So the financial instruments, financial assets, financial liabilities, all form part of the financial system. So whenever we talk about the financial system, we have the financial markets, the financial institutions, and the financial assets and liabilities. So that is what we have here. And when we talk about the financial system, what it does, it channels the funds from the borrowers to the lenders. Sorry, from the savers to the borrowers, people who have money versus people who want to give it away. So this is what it does mainly. Now it provides financial services such as insurance and pensions. So this is a high level about the financial system. Second, when we talk about it in little detail, it has three aspects to it. One is the financial market, one is the financial institution, and then the financial assets and liabilities. Markets include stock market, money market, and financial institution has banks, buildings, societies, insurance companies, and pension funds. Financial assets and liabilities have mortgage, bonds, bills, and equity shares. So this is about the financial system. Okay, doing that now. Looking into next year, the basic long-term financing decision. So what is the basic long-term financing decision that we make? It includes debt or equity. So looking into a little bit detail here, once you need money for the long term, you have a choice. You can either go for debt, either you can go for equity. Debt is basically you borrow and you pay interest. Equity is like you sell the shares and you give ownership, right? So you consider cost, you consider risk, you consider control, you consider theory like WACC, weighted average cost of capital. You look into all these things, right? You look into cost, risk, control, and WACC. You look into cost, you look into risk, you look into control, and you look into WACC. These are the three things. These are the three, four things that you look into, right? So when we talk about the long-term financing decision, you look into debt and equity. Debt is you borrow and pay interest. Equity is you sell shares and you give ownership. That you decide by looking at cost, risk, control plus theory like WACC. That is what you look into when we talk about debt and equity. And example is you need money for a factory. Either you take a bank loan, which will be debt, or you issue new shares, which will be equity. Either you will borrow and pay interest, that will be your debt, and equity will be either you will just sell the shares and give the ownership, that is equity, debt and equity. Okay, debt and equity. So whenever you have a project, you made the investment decision, you want to make the financing decision, you have two major choices, either debt, either equity. So now let's look for the practical considerations. What are the things that we consider really? So from a practical consideration perspective, first we look into the cost. If we take debt, we have to pay interest. If we take shares, we have to pay dividends. Next, risk. Can you repay? That is the risk that we look into. Next, control. Will the owners lose control? Right? In under control, we look into will the owners lose control? In tax, we look into interest is tax deductible. When we talk about tax, we look into interest is tax deductible. And then finally, we have flexibility. Flexibility is how easy to get more money, right? How easy is it to get more money? So these are the factors that we look into. Firstly, we look into the cost. Cost is interest and dividends. Then we look into the risk. Risk is can you repay or not? Control, will the owners lose control? Next, we have tax. Interest is tax deductible. And then we have flexibility. How easy to get more money, right? How easy is it to get more money? That comes under flexibility. How easy is it to get more money, right? Look into cost, look into risk, look into control, tax, and flexibility. Now, okay, cost is interest and dividends, risk is can you repay, control, will the owners lose control, tax is interest is tax deductible. That's the biggest benefit of debt, that it reduces our tax. Flexibility, how easy can we get more money if we want, how much control we will lose, can we repay, and interest versus dividends. These are the things we look into, right? So like we looked into the cost, we look into risk, tax, flexibility, all these things that we look into when we make a decision. Next, we look into the theoretical considerations. What about the theoretical considerations? So under theoretical consideration, theory says how debt affects your WACC and firm value. If you take debt, how does it affect your weighted average cost of capital? That is your average cost of capital of all the sources of finance you've raised in your company, the weighted average of that. So theory says how debt affects your WACC and firm value, right? Theory says how does debt affect your WACC and your firm value? That's what theory says. How does debt affect your WACC and your firm value? How does theory, how does debt affects your WACC and firm value? Firstly, some debt lowers your WACC. Definitely. See, if you have little debt, your WACC gets lower. Your overall weighted average cost of capital gets lower because interest is cheaper and it is tax deductible. Because interest is very cheap and it's tax deductible. So that is a big benefit. But if you take too much debt, it is high risk. WACC goes up again, right? If you take too much debt, also is a problem. If you take too less debt, it's very good. That it will reduce your overall WACC. But if you take too much debt, it's a problem because it is high risk and your WACC goes up again, right? If you take too much debt, it is high risk and your WACC goes up again, right? That is when there is too much debt. So if you have too much debt, that is high risk and your WACC goes up again. Okay, so that is one thing, that too much debt is high risk and your WACC goes up again. That is when there is too much debt. Some debt definitely lowers the WACC because interest is cheaper and it is tax deductible. Now, okay, interest is cheaper and it is tax deductible. That is about some debt. Too much debt is about high risk and the WACC goes up again. Right? Too much debt is about high risk and your WACC goes up again. Okay, that is about too much debt. Your risk is high and your WACC goes up again. Too less debt is good. That if you have less debt, it is still okay. But if you have too much debt, it is a problem. Okay, next we'll look into MM theory. MM theory, one is no tax, one is with tax. So first let's look into the no tax theory. What does the no tax theory say? Modi Gilani and Miller, no tax theory. They say that in a perfect world, what do you mean by perfect world? That there is no tax, there is no transaction cost, and there is no friction. In a perfect world where there are no taxes, okay, Modi Gilani and Miller theory says that your capital structure does not even matter. Your debt or equity, the firm value will be the same, right? They're saying two identical firms, one is all equity and one is half equity, half debt. With no tax, both are worth the same. And in real life, we have tax. So this theory doesn't fully hold. This theory works in a world where there is no tax. But in the world we live in today, there's definitely tax. So what this theory says that in a perfect world where tax does not exist, even if you are a debt fully equity firm or half debt, half equity firm, both value are the same, right? They're saying as long as tax does not exist, if you are a full equity firm or half equity, half debt, it does not matter. Your value will be the same. But this theory is not cannot be applied in practical because the world we live in, there is definitely tax there, right? There's definitely tax there, and because there is tax there, we cannot really. And when there is tax, we cannot really apply this theory. That is the MM theory with tax, right? That is without tax. Now we'll look into the MM theory with tax. Okay, now what about the MM theory with tax? So now when we look at the MM theory with tax, let's look into that. So first we looked into the without tax. Now we are looking into the with tax theory. Okay, I think there will be no difference, right? That if you with tax theory says here the Modi Milani theory with tax is something that we're looking at right now. That is the with tax theory. What does the with tax theory explain? It says that in the real world we do have tax. So interest on debt is definitely tax deductible. That is the biggest benefit of debt. So this creates a tax shield. So your debt creates a tax shield. Whenever you have debt, it creates a tax shield. Whenever you have debt, it creates a tax shield. It saves you tax. Whenever you have debt, it creates a tax shield and it saves tax. So MM with tax theory says more debt is equal to more firm value. Ideally, use 100% debt to maximize value. This again is not really practical in the real world if you think about it. Because see, if you think about it in the real world, if you take 100% debt, your company will get so much risky in terms of the financial risk of your company will increase a lot. So what MM with tax theory says, the Modi Milani with tax theory, what does it say? It says that in the real world we do have tax, and interest is on tax on debt is tax deductible, right? And interest on the debt is also tax deductible. So this creates a tax shield. What does it say? It creates a tax shield. So what we must do? We must save tax. So MM with tax says that more debt is more firm value. It ideally uses 100% debt to maximize value. What does it do? It ideally uses 100% debt to maximize value. Okay. So in the real world, we definitely have corporate tax, and interest on debt is very tax deductible. So this creates a tax shield. What does this do is that this creates a tax shield. Basically, it saves tax. So MM theory with tax says that if you have more debt, your firm will have more value. And they are telling go for ideally use 100% debt, right? They are telling ideally use 100% debt. So this is what with tax theory say, that you're getting tax shield and your value of your firm will increase as your gearing increases, and use 100% debt. So obviously this is also not something that is very practical. Why? Because if you go for 100% debt, okay, if you go for 100% debt also, we will have a problem. It's because your company will become very risky. The problem that will happen is your company will become very risky. Okay, your company will become, if you go 100% debt, just think about it, your company will get very risky, and we cannot have that. Okay, your company gets very risky and we cannot have that. Yeah, okay. So that is again something that cannot be, something that we cannot be acceptable, and that does not really make sense. That if you go 100% debt in your company, it becomes bankruptcy risk will increase a lot. Next is what the static or the trade-off theory. Okay, what does the static and the trade-off theory says? So let's look into that theory here. Static trade-off theory. Static trade-off theory says that there is an optimal amount of debt. Now, this definitely makes sense that there is an optimal amount of debt you should take. Right? The little debt that you take, it will save you the tax. If you take too much debt, bankruptcy and distress cost will increase. So the best point is where tax benefit is equal to bankruptcy risk, there's an optimal gearing. It says don't do 100% the debt. Obviously, if you take 100% debt also, there will be a problem. What you should do, yeah, don't go for 100% debt. That's a big problem. Don't go for 100% debt. Okay, don't go for 100% debt. There's an optimal level of debt that you should go for. Okay, there's an optimal level of debt that you should go for. The theory says that there's an optimal level of gearing where the tax benefits of debt are balanced against the increasing cost of financial distress. As the gearing rises, beyond this point, WACC starts to increase the again. Right? They say that there's an optimal level of debt, and you go to that. Right? Use that optimal level of debt, no problem. Right? Use optimal level of debt. Little debt is good, but don't do it in too much. Because if you take too much, then it is very harmful. Optimal level debt is fine. What they're telling is optimal debt is really fine. No problem with optimal debt. After that, it becomes a problem. Next, we have pecking order theory. What does pecking order theory says? Pecking order theory says that firms don't have a target debt level. They finance in order of preference. Okay. They say that firms should always raise finance in this order. Number one, use up all your internal funds. Number one, what you should do, use all your internal funds. Number one, what you do is use all your internal funds. Number two is after you've used up all your internal funds, then you use debt. After you used up all the internal funds, then you use debt. After you use all your internal funds and then you use debt. After you've exhausted both, after you've exhausted both, okay, after you have exhausted both, only then, after you've exhausted both, okay, after you've exhausted both, only then go for equity. हाँ बाबू. हाँ मैं बोला कार्ड पड़ा ड्रॉर मेरे ना मेरे मेरे अलमारी के राइट राइट साइड. हाँ हाँ वही वाला है. Okay. So next is a pecking order theory. They say in case of pecking order theory that rather than targeting an optimal gearing level, firm should select in this order. Which order? Number one, always try to use internally generated funds first because you know what? It is free. If you use internally generated fund, that fund is free. Then go for debt. After using internally generated funds, then you should go for debt. And after debt also you've used up, then go for equity. Okay, then go for equity. So first you go for internally generated funds, then you go for debt, and last you should go for equity. Right? Absolutely in the last you should go for equity. That is what the pecking order theory says. That first you go for internally generated fund, it is free because there you already have it. Then go for debt because you will pay a small interest. And then only then if you still need more money and you've gone to a certain limited number of debt, then go for your new issue. Then go for your new issue. So that is your pecking order theory. Only then you can go for the new issue. That is our pecking order theory. Okay, so that is our pecking order theory. With tax, static trade-off theory, and then pecking order theory. Okay, so these are these three theories. The one is with theory, static trade-off theory, and pecking order theory. These are the three theories that you should consider as you are looking into this particular chapter. When the pecking order is basically just tells first go for internally generated firms, then debt, and then equity. Static theory says go for an optimal level. With tax theory says go for 100% debt. No tax theory says it doesn't matter whatever you go if as long as tax does not exist. But in the real world, obviously, tax exists. Okay, so in this case, they give you a hierarchy, right? Here they give you a hierarchy. Here there's an optimal level of debt. Okay. Next, we look into an asymmetric approach, right? Asymmetric information. What do we mean by that? Now, what happens in an asymmetric information? Managers know a lot more about the firms. That means what? Managers know more about the company than investors do because see, managers run it day to day. So when a company issues new shares, investors would have this thought that managers think shares are overpriced and hence the share price falls. So what happens is the whole idea is around the fact that managers have a lot more information about the company than the investors do. So when a company issues new shares, investors have that thought. The managers think that the shares are overpriced. And if that is the case, the share price falls. What we mean by this is that when a company announces a new share issue, investors panic and sell. Why are they selling? There must be bad news. Okay. So the logic over here is that since managers know a lot more about the company, okay, since managers know a lot more about the company, and if managers think that the shares are overvalued, it often leads to a investor behavior wherein investors start selling off their shares. Right? Investors start selling. So ultimately, because management knows a lot more, the point of reference of the management is taken into a lot of consideration by the investors, and oftentimes what the management managers believe about the company is exactly how the investors choose to act. That's called asymmetric information. Why? And that might always not be the true sense, right? Sometimes it might not be the case what managers think is genuinely the case, because investors also have a wide pool of experience. So what are they saying here is that there's an asymmetric information. What do you mean by asymmetric information? Managers know more than investors. So if managers think that the shares are overvalued, then a lot of time investors will actually act in that way only, and they will try to sell off all their holdings. So again, it's the manager's point of view that is taken with a lot more consideration, which always might not be the case. And that's what they say. And this is all happening because of a difference in information. That managers have a lot more information than the shareholders. Moving on now, we're looking into gearing drift. What about gearing drift? Gearing drift, if a profitable company keeps profits as retained earnings, equity grows. Debt stays the same, so gearing ratio automatically falls over time. They say if a company retains lot of its profit, you will see over time its gearing ratio will fall. If a company saves a lot of its profit, it's a good thing, right? Your company is saving a lot of profit. Whatever profit you're making, you're retaining a lot, right? What is your company doing? Your company is retaining a lot. And when your company retains a lot, what happens in the long run? And if your company retains a lot, what happens in the long run is, if your company retains a lot, okay, if your company retains a lot, what happens in the long run, right? So if your company retains a lot, what happens in the long run is that if a company retains a lot, what happens in the long run is that your equity will grow. And as your equity grows, your debt stays the same. So gearing ratio automatically falls over time. That is called as gearing drift. What happens in gearing drift? That if a profitable company keeps profits as retained earnings. If there's a profitable company and it keeps profits as retained earnings, your equity grows. If there's a profitable company and it keeps profit as retained earnings, your equity grows. Debt will stay the same. So what happens? Your gearing ratio falls over time, right? So if you save a lot of your profits, you will see in the long term your debt equity ratio falls. That's all they say. Next is signaling to investors. How you raise money sends a very strong message to the investors. If you use debt to raise money for a investment, it signals that we are confident we can pay the debt back. If you raise equity, it says that we think shares are expensive and the future looks risky. So taking a loan shows management confidence in future profits. So how are you choosing to take a how are you choosing to raise money for a project sends a very strong message to all the investors, right? The choice of financing sends a very strong signal to the investors about the management confidence. Investors also analyze the resulting impact on key ratios, ROCE, ROE, gearing, right? When a firm raises new finance, okay, so a lot of times if you, as a company, how you raise money, and if you choose a certain way of raising money, it sends a certain signal to the company. Okay, so how you choose to raise money is very important, right? How you raise money sends a very strong message to investors. How you raise money sends a very strong message to investors. Okay, do you raise money through debt? Do you raise money through equity? How are you raising money? Right? If you're raising money through debt, it's sending a certain signal. If you're raising money through equity, it is sending a certain signal. So how you raise money is sending a certain signal to the investors. Okay. So how you raise funds, money sends the how you raise money sends a strong message. Are you raising it? Are you raising money through debt? Are you raising money through equity? Raising money through debt, we are confident we can pay it back. That's what the signal is. And if you're raising money by equity, we think that the shares are very expensive. and the future looks very risky. So oftentimes a debt shows a confidence that you have, that you can pay the interest that will come. So oftentimes how you raise money also as a company makes a very strong impression on the shareholders. Next, we have agency effects. What is agency effect? Agency effect is that at the end of the day, what happens is the shareholders will only give the money and they will leave. The company is pretty much run by the management. And what happens is shareholders hire the management, they invest the money, they hire the management and they leave. Now, oftentimes what happens is the management starts to act on their best interest. They should act in the best interest of the shareholders, but no, they start acting in the best interest of themselves. They start doing what is good for them, they start doing what is best for them, and that leads to a lot of problems, and that problems are come under the category of agency problem. When your gearing is high, a lot of conflicts can arise between the shareholders and the lenders. So managers may act in the shareholders' interest at the lender's expense. Lenders responds with a restrictive loan covenant. Okay, so when your gearing is high, the conflict of interest can arise between the shareholders, managers, and lenders. Managers may act in the shareholders' interest at the lender's expense. Okay, what can managers do? They can act in the shareholders' interest at the lender's expense. Lenders respond with a restrictive loan covenants. Lenders respond with a restrictive loan covenants. So when gearing is high, the conflicts of interest can arise between the shareholders, managers, and lenders. Managers may act in the shareholders' interest at the lender's expense. Lenders respond with a restrictive loan covenants, whereas lenders they respond with a restrictive loan covenants. So when gearing is high, conflict of interest can arise between the shareholders, managers, and lenders. Managers may act in the shareholders' interest at the lender's expense. Lenders respond with a restrictive loan covenants, whereas lenders respond with a restrictive loan covenant. Okay, so again, that is the problem that oftentimes between all the managers and along with that the directors of the company there can be a problem. Along with that, another effect of agency is between the shareholders and the lenders. That is the second one, wherein the lenders might not want the company to take too much risk, whereas the shareholder would want the company to take with a lot of risk, because the shareholders would want a high return on their capital, and they were telling like, and they would be like, if you're pursuing risky projects, there's a possibility to make a high return, and then we will get the upside. Whereas lenders think that if you take too much of a risk, lenders say that if you lenders might think that if you take too much of a risk, and if the project doesn't work out for the best interest, there will be a problem again and you will not be able to pay the interest. So there are two conflicts. One is between the shareholders and the directors, where the directors start acting on their own interest instead of the shareholders. And the next one is between the equity shareholders, the equity investors, and the lenders, wherein the equity investors want the company to take a lot of risk, but the lenders don't want the company to take a lot of risk, and they put covenants on the company who's borrowing money that you cannot do this, cannot do this, cannot do this, cannot do this, cannot do this. So again, that are examples of restrictive loan covenants. Cannot give more money as risk, cannot let your profit come below this amount, cannot liquidate your investments below this point. So there are a lot of covenants that will come into place, and that comes under the agency effects. Now we are getting into a little bit more specific part of the chapter here. We looked into the signaling to the investors. We've looked into the agency effects between two parties. And now we are coming to the specific financing options. Okay, what do we really understand by specific financing options? First, we look into equity. Okay, after we look into equity, then we will go into debt. So first, let's look into equity. What is really happening when we talk about equity? There are very simple topics over here that are listed down. So first, let's look into the equity. So when we talk about equity, what are they really telling us? In case of equity, we're looking into beyond the theory, firms choose a range of concrete equity and debt instruments. Each has its own cost. So first we'll talk about equity. So if you want to choose equity, in equity also various methods are there. First method, rights issue. What you do is at a cheaper price, you will issue shares to the existing shareholders of the company. There are some shareholders of the company. Okay, there are some existing shareholders of the company. Okay, there are some existing shareholders of the company. Okay, there are some existing shareholders of the company. When there are some existing shareholders of the company, you issue new shares to those existing shareholders only, but at a discounted price. That's called as a rights issue. Okay, that's called as a rights issue. What you do is, what you do is, you issue shares. What do you do is you issue shares. What you do is you issue shares. Who do you issue shares to? Okay. What do you do? You issue shares. Who do you issue shares to? Okay. First thing is you issue shares. But who do you issue shares to? Okay. You issue shares to existing shareholders of a company at a discounted price. That is called as a rights issue. Next you have is the equity finance. That is public issue of shares. You sell to the public for the first time. That is called IPO, right? What do? You sell to the public for the first time. You sell shares to the public for the first time. What do? You sell shares to the public for the first time. That is called as IPO, right? You sell shares to the public for the first time. You make shares very easy to trade. But IPO is an expensive, slow, risky process and needs a lot of legal work. But if we talk about an IPO, it is a very expensive, slow, and a risky process, and it needs a lot of legal work. So that is all about your equity finance. Next, we look into equity finance from private placing. Private placing is what? You sell shares privately to selected investors only, mainly institutional shareholders. That you don't put it for everyone. You directly go give it to only specific stakeholders and very specific group of institutional shareholders. So very specific people you directly go and sell. And when you that's called private placing. Next, we have stock market listing requirements. So if you are planning to get your company listed on the stock exchange, you have to meet a lot of rules. And what are those rules? Okay. You have to meet a lot of rules. And what are those rules? The rules are like you have to have a minimum trading record, minimum profit, minimum market value, a percentage of shares public must hold, audited accounts, good governance. So there are a lot of other areas that you need to look into when we're talking about the listing. One is private placing and other than having a requirements. Next, looking into alternative methods of obtaining a stock market listing. So where are the alternative methods? So let's look into the alternative methods of getting a stock market listing. First one is direct listing, where the company shares without any investments bank, you directly go list on the stock exchange. It's cheaper than an IPO, but there is no guarantee on price and no one to support the demand, right? So you can directly list your company shares on the stock market without using investment banks, but that is not a very convenient way of doing it. Next is Dutch auction. Here investors bid for the shares, right? This is like a auction where investors bid for the shares. The final price is set where all the shares are sold and the highest bidders pay the price. Okay, the final price is set where all the shares are sold and the highest bidders pay the price. The final price is set where all the shares are sold and the highest bidders pay the price. So that is your Dutch auction. Okay, that is your Dutch auction. In a Dutch direct listing, you directly go without an investment bank. In Dutch auction, what you do is investors bid for your share, that how much they are very ready to pay, and the one who are uh, auctioning for the highest price. At that price, obviously, you would want to sell because you're getting at the highest possible price for your particular shares. Next, we have SPAC, Special Purpose Acquisition Company. Okay, next we have a SPAC, Special Purpose Acquisition Company. Right, it's basically a shell company with no business. It does an IPO to raise cash, then uses that cash to buy a private company, gives the private company a fast route to be listed. So what you can do is you can give a private company a very fast route to get listed. So what you do is you first, you're a shell company, you don't have any business, you do an IPO and you just raise the cash. Then what you do is then you use that cash to buy a private company. So naturally a private company can easily get listed because you are going to go and buy the private company. So that is called as SPAC. Next, we have reverse takeover. What is reverse takeover? Reverse takeover means a private company buys a majority stake in a public shell company. A private company buys a majority stake in a public shell company. A private company, what they do, they buy a majority stake in a public shell company. That is a reverse takeover. That you are a private company and you buy a very big stake in a public shell company. So then you swap the shares and you become listed. It's faster and it's cheaper than IPO. What you do, you're a public company, you're a private company, you buy a major stake in a public shell company. You're a private company and you buy a major shell in the public company. You're a private company and you buy a major shell in the public company. Then what you do is you swap the shares and you become listed. So you're a private company and you buy a major chunk in the public shell company, you swap the shares and you become listed. And it is faster and it is cheaper than IPO. Next, finally, is dark pool trading system. It's a private place where big institutions trade huge block of shares. It doesn't move the market price before the trade completes. The bad thing is it's very less transparent for normal investors. So it's a private place where big institutions trade huge block of shares. It's called as the dark pool system, where what happens is, where what happens is large institutional investors, they trade huge block of shares. Okay, huge blocks of shares are traded by institutional investors, huge block of shares. Okay, so that is about your dark pool system, where huge block of shares are traded by the investors, huge block of shares by institutional investors, huge block of shares the institutional investors are starting to trade. Okay, so that is pretty much about our equity. Okay, this is how you can share your equity. This is how you can go for equity shares. Okay, last we'll just finish till Islamic finance here. So when we talk about debt now, next we'll talk about debt. What about debt? Okay, talking about debt. Okay, let's look into what do we have in store for debt. Debt finance, short and long term. Debt finance, as you know, short term can be overdraft, short loan, fast and flexible. Long term can be bank loan, bonds. It's cheaper interest, tax deductible, but fixed repayments. So long term debt, short term debt. You have two options. Next, specific debt financing. You have various other ways to borrow. For example, you can do leasing also. That instead of buying, you can just pay to use it, and once you're done, you can return it. There are various other ways as well. Okay, last two we'll look into cryptocurrency, ICO, and STOs. Okay, what about cryptocurrency, ICOs, and STOs? So when I talk about cryptocurrency, ICOs, and STOs, let's look into that. So what happens here is cryptocurrency means these are all our new ways of raising money. Under that, first we have ISOs and STOs. ICOs are called as initial coin offering. It's the crypto version of IPO. What companies do, they sell a digital token to fund a new venture. It's largely unregulated and there's high fraud risk. Next, we have STO, security token offering. It's like an ICO, but it is regulated and it is asset backed. It's safer for investors. Okay. Then we have our STO. STO is pretty much about security token offering. Right? It is like an ICO, but it is regulated and it is asset backed. It's safer for investors. It is safer for investors. That is STO. ICO is initial coin offering. It's the crypto version of IPO. Company sells the digital tokens to fund a new venture. What the company does, the company sells digital tokens to fund a new venture. Company sells digital tokens to fund a new venture. That is called ICO. It's largely unregulated and there's high fraud risk. STO, on the other hand, is security token offering, right? Like ICO, but it is regulated and it is asset backed. It is safer for investors. Okay, it is like ICO, but it is regulated and asset backed. It is safer for investors. What it is it is very safe for investors. That is STO. It is regulated also, it is asset backed also. ICO is again not regulated, it is high fraud risk. Company just sells their digital tokens. What companies will do, they will just sell their digital tokens. Okay, what companies do is they just sell their digital tokens over here. So that is again a big problem. Next we have private equity, venture capital, and business angels. Okay, so let's look into private equity and business angels. So private equity is basically rich investors give money to a private unlisted company in exchange for shares. Right? What happens over here is investors they give money to private and unlisted companies. What do investors do? Right? What do investors do? They give money to private unlisted companies. What do investors do? They give money to private and unlisted companies. Okay, what do investors do? They give money to unlisted companies. Okay, there are two types here. One is VC, one is business angel. VC, what they do is they invest in growth, new products, and restructure the company. They be part of your management also. They'll take active participation in your management. Then we have business angels. What do business angels do? They are wealthy individuals who invest early. Business angels are like wealthy individuals, and these guys invest very early. Okay, what do business angels do? They are wealthy individuals who invest very early in a business. Okay, they are very wealthy individuals who invest very early. Okay, they start investing very early. They are called as business angels. Okay, they start investing very early. Okay, that's about business angels. Okay, so we looked into direct listing without an investment bank, direct Dutch auction, SPACs. Again, these are companies which don't have any business. They get listed and they acquire a private company. Reverse takeover companies, the private takes a big chunk of the public company. It's a cheaper and a faster way. Dark pool trading system. Then again, it relates to institutional investors doing a lot of trading, selling large bulk. Okay, that's selling a large bulk. Then we have private equity. Private equity, again, like we just figured out, it is pretty much two parts here. Venture capital, business angel. Venture capital get take part in your management. Business angels at a very young stage, they invest money in your company. That is a business angel. Perfect. That is pretty much about us.